900 words. Here's the finished narration script for the Federal Reserve's missing transactions shorts. There's a legal carve-out buried in the U.S. Code called the Section 714 exemption. You never voted for it. Almost no one alive today watched it pass. And since October 1978, it has made it illegal for the government's own auditors to examine the Federal Reserve's actual monetary policy transactions. Not some of them. The trades that move trillions of dollars every year. By law, they do not officially get looked at. And once you understand why, you'll never look at independent institutions the same way again. Here's what it actually is, stripped of the jargon. The Government Accountability Office, the GAO, Congress's own watchdog, can audit almost every federal agency, dollar for dollar, line by line, the same way it checks the Pentagon and the IRS. But when it comes to the Federal Reserve, one law strips that power away for a specific category of activity. Anything classified as monetary policy, interest rate moves, emergency lending windows, transactions with foreign central banks. Under Section 714 of Title 31, those records exist. They are logged, time-stamped, real. They are simply placed outside the reach of the auditors whose entire job is to check where public money goes by design, not by neglect. This didn't happen by accident, and it didn't happen by vote of the people it affects. In 1978, Congress passed the Federal Banking Agency Audit Act after years of pressure to open the Fed's books following inflation crises and growing public distrust of the central bank. Lawmakers wrote themselves a compromise. Yes, audit the Fed's operations, its buildings, its payroll. But carve out monetary policy, deliberations, decisions, and actions, and transactions with foreign governments and central banks as untouchable. The bill passed. The public never saw the carve-out coming, and no one has ever been asked directly whether they consent to a category of federal spending Congress agreed, in advance, not to check. Once that exemption existed, it didn't stay narrow. The Fed decides internally what counts as monetary policy, meaning the institution being shielded from audit also defines the boundary of its own shield. During the 2008 crisis and again in 2020, trillions in emergency lending moved through vehicles the Fed itself classified under the exempted category. Congress can request summaries. It cannot compel the line-by-line transaction record the way it can with the Pentagon or the IRS. Federal Reserve officials briefed on the actual scope of these transactions are bound, as a condition of employment, not to disclose them beyond what the exemption already permits. The people holding the pen on where the exemption applies are the same people the exemption protects. Remember, no one voted for this. Not the carve-out, not the boundary line, not the trillions that move behind it. Here's the part that should actually worry you. This isn't a conspiracy running in the dark corners of government. It's printed, public, cited law, and that's exactly what makes it dangerous. In 2011, after Dodd-Frank forced a one-time partial audit, the GAO found the Fed had issued over $16 trillion in emergency loans to banks and corporations worldwide during the financial crisis. Loans most of Congress didn't know the size of until the audit forced disclosure years later. That was the exception. Under Section 714, as it normally operates, that same category of transaction is not required to surface at all. Every dollar the Fed moves through emergency lending facilities, discount window operations, and swap lines with foreign central banks can legally remain a number only the Fed itself has fully seen. Ordinary oversight, the kind applied to a school district or a city police department, simply does not reach this institution's core function. You are told the Fed is independent so politics can't corrupt monetary policy. What that independence actually means, mechanically, is that the transactions themselves are shielded from the one body whose job is to verify them on your behalf. This exemption cannot be repealed the way a normal regulation can. It isn't an agency rule a new administrator can rewrite. It's statute, which means undoing it requires passing new legislation through both chambers of Congress and surviving a veto, against an institution that controls the cost of borrowing for every campaign, every donor, and every lawmaker's own re-election war chest. Every attempt to fully audit the Fed since 2011 has stalled in committee. The incentive structure that would need to unwind the exemption is downstream of the very institution it would expose. That is not an oversight. That is the design holding. If a carve-out this large can sit inside plain, published law for nearly 50 years and still remain invisible to almost everyone it governs, the real lesson isn't about the Fed specifically. It's about how thin the line is between regulated and regulated on paper. Any institution can carry the label of oversight while quietly defining from the inside what oversight is allowed to see. And here's the part that should actually worry you most: it's completely legal. Nobody broke a rule to build this. They followed one to the letter, and the letter simply never let you in the room. So the question worth sitting with is this: how many other agencies have written themselves the same kind of exemption, smaller and quieter, that no audit has ever forced into daylight?